right?
No, Aaron's in the removing you. Hey, welcome guys to the People's Lender Show. Tonight we've got a special guest, a good friend of mine, another loan officer. What's better than one loan officer? Two. You get the two loan officers, two professionals, been in the real estate game. Aaron, how long you been in the game?
Like I always say, what year is this? Yeah, I've been actually originating loans since 2003.
Okay,
2003, so 20 years.
2003, man. So 20 years.
20,
20
20.
years.
Hey,
And
look,
I've been
I'm
in
like
real
I'm like
estate for
Bron.
19.
I'm like Bron, just getting better.
And so, for you guys who may be here for the first time, I'm Kevin Jefferson, the People's Lender. Today, we're going to be talking about, are you a qualified buyer? There's a lot of people who are has aspirations and dreams to be a home buyer, and they think they're in a position for home ownership. But at the same time, as lenders, we're looking at people we want to partner with home ownership to make sure that we're not going to get the property back. So I understand that home ownership is the American dream, one of the American dreams. However, we need to make sure that we're investing in the right people to partner with on home ownership. I'm gonna let my partner tonight, Aaron, introduce himself. Tell him who you are, brother.
Hey guys, Aaron Simmons. I'm a licensed loan originator. Got to hit him with the NMLS 23.638. I am wow, been in the business for 20 years. Helped thousands of clients over the years, and I look forward to having an opportunity to chop it up with you guys. And more importantly, we definitely just want to talk to you guys about some things that are happening in the industry that a lot of times us as lenders individually, I don't think we talk about in the market a lot, and that's loan quality and making sure that you guys are qualified buyers. And I think in the environment that we're in, and I know Kevin will agree with me, is that we're seeing a lot of changes in automated underwriting systems. We're seeing loans that we might have done last year that we can't do this year. And typically when that starts happening, that means that one of two things are happening. Underwriting guidelines have changed, but also they're saying that our borrowers need a little bit more to get them pushed over the edge. And that's what we're going to talk about tonight. So I appreciate you having me on the platform, and let's get to it.
No problem, man. So, Aaron, you brought out a good point. Loans that we could probably eyeball last year and
Yeah.
say, "Oh, that's no problem getting approved." What are you seeing different, or what is your bank, or what do you think the lenders are requiring? Higher credit scores, more assets? What changes are you seeing?
So one of the things that so obviously let me start off with this. Kevin and I both do a lot of government loans. So if you're a veteran, if you're looking at FHA, or if you're looking at USDA financing, some of those programs might have down payment assistance, or you guys might just be putting 3.5% down, or with USDA, no money down. Sometimes those programs used to let us get you guys approved with what I like to call higher debt to income ratios, which means that if you guys have a certain amount of debt compared to your income and compared to what the mortgage payment is going to be, like for example, an FHA loan, we would typically, if you had to throw a scenario out there, you had a 630 credit score, and sometimes you have a 49 to a 51% debt to income ratio. Man, Kevin's hitting that approve that loan button. We were doing those all day long. Now, when we're trying to get our clients pre-qualified and we're running them through the AUS automated underwriting system, those loans are coming back as either a refer eligible, or they're requiring that you guys either have more money, which is more savings, more assets, more reserves, or they want you to have a lower debt to income ratio as well. So what that means is that you got to have more, like we like to call skin in the game. You got to have more resources. And then also you have too much debt. Because if we're getting into an underwriting environment or a buying environment to where things are going to get tighter and they're going to get restrictive, that means what do you do to control this as a buyer? You got to have more money in savings, and you got to lessen that consumer debt. We're constantly preaching, reduce, pay off those high interest rate credit cards. And the reason is because that money is costing you guys an opportunity to purchase real estate. So in a nutshell, Kevin, that's what I'm seeing a lot. Last year, 630, 620 credit score with a 51, 52 DTI. I'm approving it. Now underwriters and banks are coming back saying, hey, what compensating factors does this client have to push them over the edge because we're just getting into a different credit environment.
Right. Totally. I'm seeing the same thing, man.
Yeah.
I'm even seeing some 640s and 650s asking for reserves.
Look, and that's what I'm saying. You and I, hey, look, when we listen, those deals we was doing last year, you D Wade, I'm LeBron. Throw it up, it's an alley-oop. I'm banging that thing down. You know, now I'm going back to clients saying, hey, do you have some more cash? And here's another thing I would like to talk about. Sometimes we would be able to do loans to where the client, the only funds they had in the transaction might have been a gift. I am seeing that shift dramatically to where you can have a gift for all of your cash to close. You can have a gift for all your down payment. They want the system and the underwriters are looking for the borrowers to have their own money, which means, Ms. Johnson, I need you to have 3 months of the mortgage payment. Let's say that's $4,500 at $1,500 a month. You got to have that in your own checking account. You got to have that in your own savings account, or you need to have some level of an account, a retirement account, where you can have that liquidated to where you can get access to it. That is a total shift from what we saw a few years ago and where we're going in the future.
Yeah, definitely, man. So if you're a buyer, right, and you come to myself or Aaron and you're looking to get into a home, what we're saying is we would love to allow you to get into a home with no money down, right? It would be great. But at the end of the day, that creates a higher level of risk for us as lenders. What do I mean by risk? If you have no money in the game on a $300,000 house and everybody else has contributed, the lenders brought $275 or whatever it is, the seller's given $10,000 and the down payment assistance program has given $10,000. You as the buyer, if you're in position to lose the house, it's easy for you to walk away because you have nothing to lose. You're not losing a chunk of money. You haven't invested much other than your normal monthly payments. Right. Well, you said, well, I did pay payments, but you would have been paying rent also, right? So what we have to look at is that level of risk. So like Aaron was saying, borrowers coming to us and they have a gift for all of the funds. That's a level of risk because you don't have skin in the game. Sometimes before last year, I could do, 640 credit score, a person getting down payment assistance and a partial gift, and then the seller giving some closing costs. Now I ran a scenario the other week where I had all three of those in and I had to take out one. If either they couldn't get down payment assistance, but they could get the closing costs and a gift, or one had to go, but all three couldn't work. Even though they still had a little bit coming out of pocket, they just couldn't do it because there's different layers of risk. So every time you add some money that doesn't come from you, that creates an extra layer of risk. So in this case, where you got down payment assistance, you got gift funds, and then you got the seller paying towards closing costs, that's 3 layers. Right? Yes, you can do FHA 580 credit score, but you're not going to maximize with the debt to income ratio that you can. And that's still a layer of risk, right? Also, even at 640 is a decent score and it's a sweet spot, but right now it's not strong enough. It's not strong enough. So when we say that you have to come with skin in the game, you've got to also come with minimal debt. You've got to also have a conversation with your lender and say, hey, this is what I'm looking to do. Be upfront with me and let me know what I need.
Right.
And a lot of times, I don't know about you, Aaron, but sometimes I lose clients to another lender who tells them what they want to hear and not what they need to hear.
1,000%. Yeah, 1,000%. That is, I want to backtrack, so I want to talk about that, but I want to backtrack on something you said, and it's a pet peeve of mine, but the advertisement, specifically in this credit environment, of you can get a VA loan or you can get an FHA loan and a 580 or a credit score under 620 is going to get the job done. Let me explain something to you guys, because we're not here to market. We're here to try to inform you guys, because we want you guys purchasing real estate, improving your areas, creating long-term wealth for your families, but also creating a home for yourself and your families so you guys have a level of stability. That's what real estate does. But you may not hear the word subprime very often, but typically in mortgage markets, a 620 or below on a VA or an FHA loan is considered subprime. Kevin and I originate these loans and we close them daily. Guys, there is a big difference between you having a 640 credit score and getting an FHA loan today at 6.75%, or you having a VA loan and closing a loan at 8.25%. Because I've seen them and I've done them. Or getting a VA loan and you're closing at 7.75, to where if you even had 20 more points to get to a 620, you might be getting a 7% rate. That's hundreds of dollars a month. That's thousands of dollars of interest. But the key thing is that these companies are not telling you you have a subprime bucket that you're falling into. The other thing is that the underwriting on those loans can be HE double hockey sticks. And that's not something they're going to talk to you about either. They want your blood type. They want to know where you live, who you killed, who did it, who what. You're playing like Risk back in the day, or who done it. So guys, keep that in mind. But that's why we're discussing loan quality. You get better terms when you have better credit scores. You get better rates when you have better debt to income ratios. We want you guys to have the best possible loan terms, but just going in and getting desperate and not talking to a professional or talking to Kevin, talking to myself, say, hey, Aaron, I'm at a 590. What do I need to do to get to a 640 or a 660? If you have the time to clean it up and make yourself a better borrower on paper, you drastically not only change your financial terms, but your financial legacy for years to come.
Right. And that's key, man. I'm having more conversations with clients who ask, well, if I buy at 250, what happens if the property goes down to 200? I say, stay in it.
Right.
It's not an instant lottery ticket.
Right.
Over time,
right.
the house is going to appreciate and depreciate.
Right.
Honestly, man, mortgages are for people who are looking to live in a house between 5 to 7 years.
Yeah.
You're going to get appreciation. Right now, we're seeing appreciation in houses just because there's a huge shortage, but it's a long game. So let's say you purchase this year, and June of next year, we see a tick in housing prices go down.
Right.
That doesn't mean you need to sell. Because if you sell, you're going to short sell because you're not going to make your money back and you're going to ruin your credit. If you still have the ability to afford that house, continue to stay in there and the market's going to increase. Right. People, I was talking to a site rep at a home in a new development new construction, right? Okay. They had new construction in a different phase in this development. One of the people there, the house was built in 2008. So you know what the market was like in 2008.
I was there.
Right? Me too. They stayed in that house from 2008 to now. They purchased that house. I believe it was like $200,000.
Right.
Those houses are selling for $800,000. And they're still building. They got another phase to go.
Right, right.
And they're staying there. 2008, if they brought that house in February 2008, it was probably worth less in April of 2008.
Oh, that's a fact.
Because that's how bad the market was.
or they were around people that were selling them for less. Like they was
less.
It was a crazy time. Absolutely. Yeah.
Yep. So like when you're looking to purchase a home, it's a long-term play.
Yep.
A lot of people go into rentals and nobody intends to stay in a rental for 10 to 15 years, but it happens. It happens. Like we moved to our house and my wife was like, this is our forever home. But then probably a year later, she's like, yeah, we need something else.
Right.
We're still here.
Right.
But you're always looking and you can't time the market. Like you really can't time the market. So let me ask you a couple of questions, A.
Yeah, what you got?
This is, are you a qualified borrower? Mm-hmm. Are you a good loan? What does a good loan look like to you?
talking about
A
today.
good borrower. What does that look like to you?
Yeah, good borrower. So typically, we're always looking for a couple of characteristics. One of the ones that is really underrated, but for me, is your capacity, which is your ability to repay the loan, and that's your employment or your job history. How strong is your income? Obviously, it's a pet peeve. Not going to get on my soapbox now, but people partnering up, especially in this economy, two is better than one. That's why we're doing this. And having two strong borrowers on a loan, whether you're married, a partnership, or whatever you got going on, it's extremely, extremely helpful because the constant conversations that Kevin, and I don't even have to say it to Kev, we're getting a phone call today. Young man says, I want to purchase. I make $55,000 a year. Kev says, where you want to purchase? They say Metro Atlanta. Kevin is just looking at the phone because he's like, you're looking at a condo that's going to have a high condo fee. You're looking at a single family. It might start $350,000 to $400,000, or you got to move all the way out, and your income is not strong enough to be in this particular area. So you've got to move further out. So I'm always talking to clients. Number one, having a strong income, even having secondary income or second job, something you've been doing for at least 2 years or something of that nature. To me, because debt to income ratio, Kevin, is becoming such a major issue. And I'm not just talking just on the lending side. I'm talking about in real life because of inflation. Everything is getting more expensive. So your housing is more expensive. Your fuel costs are more expensive. Excuse me. One of the reasons why fuel costs is so vital is because everybody says, well, what are the gas prices? Well, if fuel prices goes up, what happens to the trucks that are on the road that have to bring you your food in the grocery store? Their cost goes up. What happens to the trucks that are on the road that have to bring you appliances that you need to purchase? The trucks that have to be driven to fix your HVAC or any necessary utilities? The trucks that are on the road that you just have to get your gas, your garbage picked up, all driven by fuel. So now you have all these things that are going up, and I am a stickler for people having large amounts of consumer debt. And I know some people had to take out credit cards, but you start to see the effect that has when you're trying to purchase with your debt to income ratio. And then I'll be quiet. But somebody buying a house, $55,000 and only got this one car note, that's $300-400 a month, is a lot different than somebody that has a $900 car note and 5 or 10 credit cards and they're paying out the wazoo. So debt to income for me and having a strong income right now is super important. Another one obviously is credit, but the amount of consumer debt is going through the roof, and this is an opportunity for people to make a lot different financial decisions. I know it's hard. I'm starting to see a lot more, not going to name the companies, but big time high interest rate installment loans, Kev, because people are in trouble. So they're going down to these companies and they're like, oh, we'll lend you $15,000. But when they come to you and I, and we start talking about debt to income ratio, and we take out that amortization schedule, and I'm like, hey, you borrowed $10,000, but the terms of this are $540 for the next 65 months. And then we do the math on that, and they're like, wait a minute, I'm paying them back 25, 30 grand. That's real money. That's real money. That's down payment. That's paying off debt. That's savings for you and your family. That's investments. So debt to income ratio and just also making sure that you are strong with as little consumer debt. Those are two that I would really, really focus on, because the credit kind of takes care of themselves if you got the low debt and things of that nature, if that makes sense.
Makes sense. So how would you advise someone to start paying down under consumer debt? I'm sorry.
There's a lot of information. I know people, they get on Dave Ramsey, but the one thing I do like about Dave, Kev, is Dave wants you to get aggressive. Like Dave is like 30%, basically, and I had a buddy of mine, shout out to my man Ray, but shout out to the big homie. But Ray always told me, he said, if you got a credit card with high interest rate debt, you should take the money out your pocket that you got right now, pour some gasoline on it, and light a match. Because that's literally what you're doing every single month. Every single month, that's what you're doing. You ended up paying $35 over 2 years for a $7 Happy Meal. But that's how we have to think about it. So the first thing you do is you start with the small one first, which is a small victory, and then you work your way up. There's a lot of podcasts. I've been binging on this, and I want you to go. There's a lot of podcasts, Kev, I've been watching about millionaires and habits and just everyday people, but they all have this one thing in common. They all don't like high interest rate debt. Most of them didn't have any debt. Most of them had one credit card, and most of them lived very, very minimalist lifestyles, but a ton of capital, a ton of liquid assets, a ton of real estate. And these people were not making millions and millions of dollars. Some of these people were making 55, 60, or their family making $80,000, but they managed their money well because they ran from debt and they made different decisions. So in a nutshell, that's just the one thing. You start with the smallest one and you work your way up. And listen, if you're in a fire and you're in a building, you're not looking around hoping that it doesn't get any hotter. You need to figure out how to get out that building. You know what I'm saying? So you might have to get a second job. You might have to start selling some stuff. But you got to get out of that burning building so you can put yourself and your family in a much better financial spot.
Right. And I'm glad you touched on that, because that's one thing that I talk to people about. Second jobs. I don't know anyone who has a second job that is doing exceedingly well.
Right. Right.
The second job isn't for you to get more debt and be able to buy more things.
Right.
I say the second job is to help you pay down on some debt. Mm-hmm. And let's just be honest, with the rise in cost, sometimes you need, depending on what you work on your first job, you may need a second job to help you pay your bills. I totally understand that. But what I tell clients, they said, well, what if I get a second job? The first thing is, if you haven't been working 2 jobs consecutively for 2 years straight, you can't use that other income to help you qualify.
Right, right.
But you can use that income to help you pay down debt. You can't use that income for your down payment and closing costs, your earnest money deposit. So if you're going to get a second job, don't use it to go on vacation or to buy the newest pair of Jordans or more video games. Use it to help position you to be a more qualified buyer. There are some people, and we talked about this, there are some companies that will close the loan and everybody walks away. The buyer walks away with the house. The seller walks away with their money. The realtor has their commission, but then there's back-end problems on that loan that nobody knows that mortgage companies or mortgage loan officers deal with. I'm dealing with 3 right now.
Buybacks or suspense conditions?
2 could potentially be buybacks. The other ones are where they wanted additional documentation. It went to HUD and they said, hey, this isn't sufficient. We need more documentation. You know how hard it is to get up with people after closing sometime, even if you have a relationship with them?
Oh, 1,000%. And shout out to the person that just said, but let's back up on that. So what Kevin is talking about specifically is that in lending, like Kevin said, we close the loan, everybody's holding up a sign, y'all holding keys up, y'all high-fiving, everything is good. We have to typically, as lenders, sell that loan on what's called the secondary market or to sell it to that investor. So that investor is now auditing our loan and making sure we've dotted our I's and crossed our T's. From 2020 to now, actually from 2021 to now, we have had a record number of buybacks. Most people might say, well, why? Loan quality? Loan suspended? What's the reason? Well, let's be honest, because nobody ever wants to talk about this. We were basically in an environment for 2020, 2021, and the beginning of 2022, or what I like to call money was on sale, which means that you could walk into somewhere and say, hey, just give me 3% and I can go buy this house. That's not a normal lending environment. When money's on sale, you got a lot of people buying stuff, but the cost is so low, guess what happens? You have errors. It's like when everybody's moving fast and you're doing 10 million loans a month, Kev, like we was rolling, all of a sudden, didn't get that pay stub, didn't get that bank statement. Man, this person really didn't buy this property for it to be a primary. These are all things that end up getting discovered later. But as lenders, our secondary market, and we both work at great companies, they are starting to get the phone calls and get the information where like, hey, all these loans had errors, and guess what? We don't want to service them, or we're not keeping them on our books. So now Kevin and I are actually reaching out to borrowers that might have closed months ago on items that we need to make sure that you have what's called a sellable loan. This is something that is totally different for the industry, but what it helps is that We don't want anybody calling a loan. But what we do is we're trying to talk to our clients now about loan quality, making sure we have everything up front, making sure you guys have the adequate amount of reserves, making sure you have the right resources and the correct credit score. So this is a different lending environment, Kevin, that anybody has ever seen, because everybody was in total utopia 3 years ago. And now as professionals, we're in it. We're trying to make sure that we're managing and make sure people have reasonable expectations about what's happening. But it is a different lending environment today, that's for sure.
Cool. Hey, we got a question, brother.
Yep.
It says, can I use my daughter's disability as income? I also work 2 jobs.
So, great question. So, there's a little bit of nuance to that question. So, number one, if you are her executor, Kevin, or a power of attorney or something of that nature, but if the income comes to you, and I've seen that in different cases, not sure about yours specifically, but I'll even use an example. I had a loan that closed recently to where the dad was getting Social Security income for children from someone that passed away. You're able to use that income. It's all, if it goes to you, ma'am, you can 1,000%. In most cases, use that income, but we need to check what's the program, what the guidelines are. But typically, if it's coming directly to you and you were that person's parent, 1,000%. It can't come to you, but then be at somebody else's address. I've seen that one too. So hopefully that answered your question. Great question, though.
Yeah, that is a great question. Yeah, and he's right. And if you have 2 jobs, as long as you've been working both jobs for 2 years consecutively, at least, then you should be able to use them. I'll expound on it. If you work at Microsoft and you've been there for 3 years,
right,
and you also work at Google and you've been there for 2 years, you should be able to use both incomes. But if you've been at Microsoft for 3 years and you've only been at Google for 12 months, you're not going to be able to use both of those incomes. It doesn't matter if you worked at Oracle a year before that, because it's all the same industry.
Right.
It has to be the same 2 jobs. And I've had people get pre-qualified from another lender using those, and it came to bite them in the butt. And then they end up coming back to me, and it was like, you were right. It was like, one thing that I pride myself on is job history and verification of employment. Right. If I don't know, I'm asking your employer. We've got it, and that's just vetting the person and the process.
Right.
Okay, Karen, good. The other thing is, man, I think that, in my opinion, what I'm seeing is, before, you could be okay in all 3 areas. When I say 3 areas, okay score, okay DTI, I mean, your DTI could be kind of high, as well as the assets be kind of shaky.
Yeah, that's a good point.
And,
yeah, I see where
you know what I mean, kind of shaky.
Yeah.
But now, it used to be 2 out of 3. I'm starting to see you have to have 3 out of 3. You got to have the assets, you got to have a low debt to income ratio, and you also have to have sufficient funds. When we say assets, we're talking about cash in the bank, not in the mattress, but cash in the bank.
Yeah.
And then maybe some type of retirement plan, whether it's a 401k, 403b, IRA, something that shows you have some liquidity if something were to happen, or showing that you're strong on paper.
Right.
So, why are they tightening up? Because they don't want to see 2008. And that's the thing. People are saying they're waiting for 2008, but lenders have gotten smart, because nobody had ever seen anything like that market.
Right.
Right. So now they don't want to go back to where they're constantly taking properties, foreclosing on people's homes, because banks don't want the properties back, contrary to what a lot of people believe.
Yeah. Can I say something real quick? Because there are these things that you have a lot of people on just different platforms, and the thought process, and it might be some buyers. We might have somebody that's out there right now watching this, or might watch in the future and say, Aaron, you know what? Forget everything y'all talking about. I'm going to wait for this thing to crash, and I'm going to get my $500,000 house at a discount. I'll need people to remember one thing. When you have real estate crashes, typically you have crashes in employment. You're in a recessionary environment. People are losing jobs. Everything is high. It is total disaster. You cannot be immune to think that some of those things will not happen to you. So one of the things that people are wishing for something that they really don't want to happen, because that affects the entire country. Kevin and I were around at that time. The devastation that it caused on families to lose jobs, to lose their homes. I remember people being out of work for, I mean, literally depending on their skill set for years. People having to be foreclosed and end up renting, filing for bankruptcy. There's this total economic devastation that can happen to a family, to where if what we're telling you guys as professionals is we focus on getting you guys to have good financial habits. And one thing I do want to talk about real quick, I want Kevin, we just shift somewhere, but as loan officers, particularly Kevin and myself, we have a great view of helping you guys with your finances overall. Here's why. Aside from telling you what kind of investment vehicles, we look at your credit, we look at your income, we can look at your bank statements, we look at your spending habits, we look at your retirement plan. We see everything from an economical standpoint that basically no other professional, licensed professional in the country can see. Those of us that are professionals that are serious about helping our clients, we have a very keen sense and a very good starting place to help you guys financially. So having a great loan officer in your corner, particularly in every economy, but going into this economy, to me, it's almost vital. So even I've had clients, and Kevin has too. I had a client I'll never forget. I said, hey man, before you buy that car, you need to call me. He said, Aaron, I know you said for me to call you. What do I do? I said, you go to the credit union. You don't have to be at that car dealership for 5 hours. You get pre-qualified first. You get your finances in order. You have a good credit score. So when you go to the dealer doesn't dictate your terms. You dictate your terms to the dealer. That saved him not only hours, but thousands of dollars in interest, but he was able to talk to a professional like Kevin or myself that can guide them in the right way. I'm going to say this. Y'all need to tag along to a good loan officer. Keep them in your pocket. Bug us. Ask Kevin questions. Ask me questions. But we're here to see you guys flourish financially and economically for years to come.
Cool. We got a question here.
Yep.
Who does it benefit when your mortgage loans are sold?
Oh, that's a great question. You want to take that one? You want me to take it, or what you want to do?
You can take it.
Okay. So when your loan gets sold, when you say benefit, let's make sure that I'm understanding your question, but let's look at it overall. Mortgages, when they get sold, lenders profit off of, number one, the interest, but also the servicing rights, which is the right to collect payments every single month. So when your loan gets sold, the servicer is making income, the loan officer is paid one time, but the mortgage, and the investor that decided to write the note for you, they make the profit or whatever that fee is at that particular time. So when you say benefit, you're benefiting from purchasing the home, and you're getting the right to basically rent that house from the bank, and you can profit off the equity. But the lender is going to benefit from you paying your mortgage every month and paying interest, and you have the servicer, which is going to collect servicing income. So I just want to make sure I was answering your question correctly. But the servicer and the lenders, so the initial investor, and then whoever's taking over your mortgage payments that you pay every single month, those people profit directly and they benefit directly.
Cool. That's a great answer. So if you owe the IRS but in non-collection status and doing a voluntary payment plan monthly, can you still get approved for a home?
Is that
absolutely
voluntary?
Yes?
That voluntary? Okay, I just want to make sure. You said what, Kev? Absolutely yes?
Absolutely yes.
1,000%. Yep.
Absolutely yes. Now, there's a caveat to that. If you're making payments, but you don't have a payment arrangement set up, I advise you to get a payment arrangement set up, because you can make payments to the IRS and not be in a payment arrangement situation. Right. We need to document a consistent payment. Example, you owe $10,000 and you say, hey, I'm going to throw what I can at the loan. So some months it's $250, some is $500. An underwriter is going to ask for a payment arrangement to show a consistent payment that is being paid to the IRS and an established payment plan. Right. But you definitely can do it.
Yeah, don't duck the feds, y'all. I'm going to say it just like that. Don't duck the feds. Don't listen. People's accounts being frozen. Listen, Kevin, no, we've been doing this years. People's accounts being frozen, the feds going into your bank account because you ignored them people is a real thing. We have seen it. If you make sure you're contacting the IRS, making a payment arrangement, because you don't want to, if they start talking to you and you don't respond, they're not going to call you. And the next thing you know, you're going to look in your bank account and they're going to be in your bank account. And you're going to say, I didn't give you permission. And they're going to say, you did give us permission when you didn't call us or respond to our letters or our things in the mail. Don't duck the feds, y'all. Don't duck them.
Exactly. I'm going to reset the room, Aaron. So, hey, guys, I'm Kevin Jefferson. This is my main man, Aaron Approves Loans. 2 loan officers. Aaron's been in real estate for 20 years. I've been doing it for 19. What we're doing today is discussing what makes you a qualified borrower. What makes you a good loan? What makes us want to give you hundreds of thousands of dollars for you to purchase a home? If you're watching the replay, do us a huge favor. Hit the subscribe button. If you have a question, drop it below. If you're currently watching it and you have a question, drop it in the chat. We're here to answer the questions, whether it's myself or whether it's Aaron. We just want to help people. We're educating people about the process. So whatever question you have, whether you're currently under contract, even if you work with a different loan officer and just want a different opinion, I'm going to give you my viewpoint based off the way my company lends and the way I interpret the guidelines. Aaron's company may do something different, or he has a different way of interpreting the guidelines. But either way, you got almost 40 years of real estate experience right here, and you can ask us any question you want. Let me see. Does it go for student loans?
Yeah, probably need a little context. Maybe she might have been referring to the payment plan, but we got the student loan guru right here. So go ahead and just go ahead and make it do what it do, as they say.
Make it do what it do. Drum music, please.
Yeah, man.
No, I understand what you're asking, Karen. So for student loans, depending on what loan type you're doing, if it's FHA, you need to either use the fixed payment, which is the amortized payment, which is a fixed payment across the life of the loan, 0.5% of the balance, or an income-based repayment plan. The income-based repayment plan has to be at least $1 or more in order for us to count it. If it's at 0, we have to use the 0.5%.
Right.
So if you're paying your student loans and you're just paying stuff to them, they're the government too. So they're going to take whatever you give them. So you want to get an established payment plan with them to make sure you can qualify. Caveat to that, if you don't have a payment plan set up, call and get an estimate before you get into that payment plan.
Right.
Because sometimes that 0.5% is less than the income-based repayment plan that you would get based off your income. So you can buy a home with the student loan debt. But again, having a conversation with the loan officer and allowing for them to look at your profile will help them guide you to which way to go, whether it's the income-based repayment plan or whether it is just use the 0.5% and be done with it. Hopefully that answers your question.
What we got?
Got another question. Is it better to go to a credit union or a bank for a mortgage lender? So I'm a direct mortgage lender. I'm going to say throw them both in the trash. Nah. So Aaron, I'll let you answer first and then I'll piggyback with my opinion.
So I think that's a great question. I think it's really what people have to understand what they're going to get and what the expectations are. So typically credit unions have their own, what we like to call portfolio, which means they service all their loans. They keep those loans on their books. If you're servicing all your loans and you're keeping them on your book, the loan quality has to be pristine. So what ends up happening is that that credit union might tell you, we have a 100% financing program, no PMI, no money down. You got to put $250 in a deal. We do this deal all day long. You get excited like, woo, yeah, girl, I got this or whatever. You go apply. They say you got to have a 720 credit score. Your debt to income ratio can't be more than 41%. And we need 3 months of reserves. And you can't have any payment shock. And you have to have a verification of rent for the last 24 months with no lates, no derogatories on your account, things of that nature. Well, for a lot of people in this economic environment, that's a perfect loan. Most people don't have perfect circumstances. So credit unions are typically, in most cases, for what I've seen, to where the underwriting is going to be very, very stringent and you fit into an exact box. Kevin and myself, as lenders, we have so many different boxes. So you might not fit in a conventional box, which is you got to have excellent credit, 5% down, but you might fit in this FHA box with a down payment assistance and you have a debt to income ratio of 51 or 52%. Or you might not fit in the credit union box that says, hey, we have a 3% down program and this is a super low interest rate, but you don't meet one criteria, but we have a little bit more wiggle room and things of that nature. We also can close loans faster typically than a credit union because they don't have the capacity or the staff. They do auto loans, they do installment loans, they do private loans, and they do mortgage loans. All Kevin and I do every single day, 24 hours a day, 7 days a week, is mortgages. And we can close a loan for you in 2 to 3 weeks. Most credit unions typically, and I know some of the big ones and I compete with them, they can't compete with my turn times. So you might get similar terms, but in a competing environment, you want somebody that can close in 3 weeks, or some of the bigger banks or credit unions that say 90 days. So it's just, you just have to weigh the options and see the pros and the cons and see which one works specifically for you and your family.
Right. So I piggyback everything he says. A lot of times people go to banks or credit unions because they offer typically some introductory or lower rate.
Right.
Right.
Yep.
I will say that the person, typically people at bank and credit unions aren't as savvy as we are in terms of the loan process. So they don't see what we see on a regular. So if it's a bank, they probably see more conventional than they do FHA.
Right.
Or they may not offer FHA. So I know some banks that don't offer FHA. I know some banks or credit unions that don't offer VA loans. Some have great products where it's proprietary to them, so it's a portfolio loan, but they're still very stringent on what they offer. I say if you're going to compare, just compare as apples to apples and oranges to oranges. Sometimes I've gotten loans from Navy Fed or bank credit unions like that who are great institutions, but their appetite for higher debt is very low.
Right.
So that same person with the same score came to us because we had a little bigger appetite than Navy Federal, and we were able to close the loan because she just needed those extra debt to income ratio to allow for her to qualify for what she needed to buy a house.
Right. Perfect. Great questions, guys. Super great questions. Had to move around a little bit. Great questions, guys. What you got?
No problem, man. Again, guys, if you have a question, you're in the home buying process. If you're new to my channel, give me a thumbs up, answer your question below. Also hit the subscribe button to get notifications when we go live. Aaron, tell them about your YouTube page.
Aaron Approves Loans. Reach out. Listen, Kevin is like the OG samurai master to the YouTube. I'm just getting started, but yeah, subscribe to my YouTube page. You can also follow me on IG, Aaron Approves Loans. You can also follow me on Facebook, Aaron Simmons Team, and I look forward to having an opportunity to serve you guys. But great questions tonight. I love questions, Kev, because that means people are actually thinking about their financial circumstances. They're thinking about how to get in position. And if you're thinking about getting in position, you're going to get in position. So appreciate you guys. Appreciate the support.
Right. Let me ask you a couple of questions, man.
Yep.
You do a lot more new construction purchase and financing than I do.
Yep.
What are you seeing on that side in terms of the quality of buyers that are buying the new construction? Is it any different than someone buying resale?
No. And that's the funny thing is specifically if you're dealing with big builders like what I deal with on my end. I work with a huge builder, one of the biggest builders on the East Coast. What most people don't understand is that you don't have to buy the lot because the builder is, so for new construction, if somebody wants to buy a brand new home, With a bigger builder, typically the builder is going to carry the cost of the lot. So that saves you money. The builder is going to carry the cost of construction. So you don't have to get what's called a construction loan to where you are helping the builder finance the deal. You get what's called the end mortgage, which means they're building the house for you. Here's the best way to think about it. You walk into Kevin's the builder, I'm the buyer. Kevin says, hey, Aaron, I see you're interested in our product. I say, yeah. I say, Kevin, I want to buy this $300,000 house. Kevin's going to say, okay, I need a $7,000 deposit from you. It's going to take me 6 months to build you this house, but I'm building it with my own money. The only thing you have to do is make sure that you get financing. That financing can be FHA. It can be Chenoa program. It can be down payment assistance. It can be VA. It can be conventional. How does that benefit me? The builder is carrying the cost of the construction, not me. The builder already bought the lot. The builder's doing the financing. The builder's paying the subs. The builder's paying the workers. The builder's getting the permits. The builder's doing everything. I just have to make sure I am financially stable in 6 months from when I write that contract to when I go to closing. I have had a lot of clients that started off in the beginning to where they might have had some work to do, but new construction worked for them. Why? Because we gave them a 6-month plan on how to close on that house, rebuild their credit, and get everything done. So new construction actually for many people, depending on their price point and their goals, is super important. Now, one of the major hiccups that people don't understand, yep, I'll answer that, Barbara, in a little bit. But if somebody's going to build you a $300,000 or $200,000 or $500,000 house, they're not building that house for you with no earnest money. You got to give that builder some skin in the game, because essentially, remember what I just said, they are building that house for you. I like to call it on consignment. They're like, hey, I'm going to build it for you. When you get the money, you pay me later. And so from a builder standpoint, the builder's taking on all the risk. Now, typically, that deposit that you give in most cases is non-refundable. Why? Because they're taking that house off the market and they're building it for you. So you got to keep that in mind. And yes, to answer her question, Kev, builders do have different incentives. Some builders have big incentives. Some builders don't. I just closed a loan today for a new construction client. He didn't go with the other builder. He came with me because I had better service. I had better terms. And my loan expectations for him and his family were a lot better than the builders. And it was also a better fit for him. He said, hey, Aaron, I'm going to stay with you. They weren't even offering me that much incentive anyway, and you actually were able to match it in some ways, but I built a rapport, and I had a much better loan experience. So it's different strokes for different folks, but yes, there are some builders, and Kevin will tell you, we compete with builders every day. Somebody throwing 15, 20 grand at you, Kevin and I are going to tell you, hey, look, that's a good deal. Go ahead and take that money. But if we have an opportunity to compete because of our service and the rapport we build with our clients, we're typically able to match or beat those terms or help you guys.
Right. So I don't work with as many builders or do as much in terms of new construction. Occasionally I'll save a deal that their preferred lender couldn't do. And, sometimes we're still able to get the incentive because their preferred lender couldn't do it. One of the most asked questions that I'm getting right now is, can I do down payment assistance and get the builder's incentive of $15,000? I tell the borrower, no. It depends on the builder.
Right.
But typically those incentives, the lender, and you correct me if I'm wrong, the builder and the lender are both giving something from what they would make in order to make that an incentive of $15,000 for the buyer.
Yeah, 1,000%.
Right. And if you throw in a down payment assistance program, lenders don't always get compensated the same for a down payment assistance program.
In some cases, and like, for example, the company that I'm with, if you have down payment assistance that are available, like, for example, I have a new construction deal going on. I do a lot of business in South Carolina, so SC Housing. So I have a client that's buying through SC Housing, getting the builder's incentive, and then also using down payment assistance. So it is possible, but it depends on the builder, depends on what state you're in, and it depends on what does the deal look like. Like
Right.
it's all going to be, everybody's situation and circumstances are a lot different. So it's not a flat no, but you need to make sure you're talking to a builder that does a lot of experience. What you laughing at, man?
I'm laughing at what you said. It depends on the builder and depends on the file. 580, no money, and you trying to get down payment assistance
It's
and the
rough.
incentives probably isn't going to work.
Yeah, that's rough, y'all. That's rough.
That's
That's
probably
rough.
not going to work.
Yeah, that's rough.
But like I said, he does more new construction than I do, and it also depends on the area. I know here in the Metro Atlanta area, nah, they not doing that, man. If you're doing the USDA, that's a different story. If the
Yeah,
property,
1,000%.
yeah, that's a different story. Contrary to what people believe, USDA is not a down payment assistance program. It's a government program, just like FHA or VA. But that's good information to know. I get a lot of questions about new construction. I know some, but I'd rather hear your answer because you do a lot of new construction. So once you have a pre-approval, do you give customer tips to work towards a solid approval? Yes. In this case, Miss Carmen, you and Mr. Wayne are a solid approval. If you needed anything, I would tell you what to do.
Look, she came through. She made
She
sure to
came,
make sure, Cam. Hey, Cam,
you
what we doing?
up here talking about solid approvals. Do I have one? Do I have a solid approval? You didn't
That's
give
what's
me
up,
no
man.
tips. Now, Miss Carmen, you and Mr. Wayne are a solid approval.
That's all right.
Thank you for reaching out to me. Thank you for always joining the lives. But if there was something that we needed to do to make you a little bit more solid, I would definitely tell you. Because my goal is to have, I don't know about Aaron, my goal is to have the smoothest transaction I can have.
Facts.
So if I think there's anything that you can do to improve your situation, I would definitely tell you. As minute as if you have disputes on your credit report,
Right.
to get them taken off before we get to underwriting, because they're just going to ask me to ask you to get them removed, and that could change your score. Yep. I saved the deal because of that one time, because the lender they were with didn't ask them to remove the disputes. And when they got the disputes removed, their credit score dropped. Oh, and that lender could no longer approve them. And we hadn't changed any guidelines. And we just worked, me and my team worked our magic and know-how to get it done. And who your loan officer matters. Who your team is matters, from the experience level of your realtor. And let me preface experience level. I know agents who've been licensed for 15 years and haven't closed 15 deals. And that's no knock on the agent, but amount of years as a professional doesn't equate to your knowledge base.
That's a fact.
It doesn't equate to your knowledge base. But having, and I'm not saying not to use somebody that's inexperienced, you just have to acknowledge the fact that you have to have strong people on your team. So I've dealt with new agents who I have helped guide through transactions because I'm a solid lender. And when I was a realtor, I had a solid lender, or even the listing agent was like, hey, Kevin, we're going to accept your offer. Can I give you some criticism? And I say, yes, write your offers this way, and it makes more sense. I don't know everything. Yep. And I still get in situations where I have to ask. I ask Aaron questions all the time.
Yeah, we always back and forth.
Go back and forth because he sees things that I don't, or he may not have done it since 2003, or I might not have done it since 2014. You know what I mean? So having a strong team to help guide you through. And if I had to say anything else about your team, before you make any decisions that you think may benefit you, run it past your loan officer if it has to do with your loan. And if, in terms of trying to do something on the real estate side or backing out, have a conversation with your agent before you decide, hey, this is not what I want to do, because it might not be as bad as it is being portrayed.
Yeah, I constantly ask, and I get it a lot. I constantly ask people, do you have representation? Constantly from the real estate side, because when you do as many loans as Kevin and I have done over the years, we already know who doesn't have a realtor or not. Or if they do have a realtor, that realtor is not servicing you properly because you're asking the level of questions that should be directed. And we as lenders, we want everybody to have a great experience, but also we want everybody to do their due diligence. I think I told the story at IG. I'll tell it real quick. I was overhearing a conversation with some friends and some family. They just talking, and it was like, oh, this house got this, got that. It's in the wrong neighborhood, and such and such, and such and such, and such and such. And I said, you got a realtor? And they was like, yeah. I said, she hasn't asked you about where you want to be, the neighborhood, your expectations, your timeline, anything of that nature. Kevin, they're looking at me like a deer in headlights. And I'm sitting there saying, those are questions that you have to have for a professional. If somebody's going to be making 1% to 3%, they need to answer all them questions plus. That's just my opinion. And same thing for us as lenders. You guys have expectations. I see some of Kevin's clients are on here, and that's fantastic. But you know you're going to get a certain level of response, a certain level of service. You're not going to be blind. I've got 5-star reviews on Google. I can't make those up. The clients come into the office. I take my time. I build a rapport, and they want to work with me. I can't do that based upon not doing a good job in servicing my clients. It just doesn't happen that way. We're in a referral-based business, but the most important thing, we don't make a penny until you get what you want, which is you get into a house. We're doing credit cleanup. We're guiding financially. We're doing debt plans. We're doing budgets. We're guiding people on how to buy things. And I've had that happen for clients for 10 years. And then they finally end up, I was guiding them for 10 years and they bought a house. So the work we put in up front, when you have professionals like myself and Kevin, take advantage of our knowledge and our experience because we've been around for a minute, but we've seen every problematic loan or every easy scenario you can think of, but we're always learning every single day, always learning.
Always learning, man. Always learning. So to answer your question, Dr. Audrey, I, myself, and my team were able to help you in 46 states. I'm not able to help you currently in New York, Massachusetts, Rhode Island, or South Dakota. However, I do have referral partners in that area that could send you to that would take great care of you. And at any time, if you have questions that they can't answer, reach out to me. So if you're in one of those areas of those 46 states, let me know. And my team can also help in DC as well.
Right.
Aaron, where can you originate at?
Oh, so I'm a little more East Coast because we have a different lending setup. So I am North Carolina, South Carolina, Maryland, Virginia, Florida, and Georgia. Done a ton of business in Virginia, a ton of business everywhere, but on those East Coast states. And if we can serve you in those states, we definitely will.
Got you. Awesome, man. Awesome. So I'm going to do something that I've never done before because I always want to know. There are currently 17 people watching this live right now.
Oh, that's dope. Shout out to them.
Right? We've got 5 people asking questions. To better serve you, and I mean this from the bottom of my heart, what are you looking for? Like, what you're on here for something. The count has been at 17 for the last 15 minutes, and 5 people are asking questions. What is a question? 2 things. If you don't want to drop it in the comments, my contact information below. What questions do you have about the process? Or are you just trying to gather information? And if you're here gathering information, I'm going to say my channel is a great place to start because it's a no fluff. And then this week you tuned in and you have somebody that has 20 years experience. So you almost got 40 years of mortgage experience and real estate experience here. What is it that you want to know? What has you here? Are you on the fence? like kind of drop some information, because I want to make sure that when I go live or I bring on somebody live, I'm serving my audience's need. I want to make sure you get your questions answered. If I can't answer your question, and some people have asked me questions that I can't answer, but I tell you to reach out to me and I'll get it answered for you.
Right.
You ask me insurance questions. That next week, I brought an insurance agent to answer your insurance questions. I just want to make sure I have the ability to serve my clients or people. You may not even work with me, but I want to be able to provide valuable information, because what I've learned is with first-time home buyers, even though they listen to you, they always want to make sure that what you say or what someone else says can be verified.
1,000% facts.
So that's another reason why I brought you on, Aaron, because I know it's two different perspectives. You know, we're state apart, but we see a lot of the same things.
See a lot.
Your expertise, I would say, is more new construction than I am, even though you do all loans. And then I do the student loan part, and I'm able to navigate through that. So like we have different specialties, but together, we help each other, and we don't even work at the same company.
No, it's not. Truth be told, it's not weird, because we're just professionals that just want to see our communities and just see people grow. And we do what we do because we want to have the opportunity to work with clients, but also there's a need. And for me, I see a lot of bad information. Kevin knows I see a lot of bad information, and people are just not being served properly. And also, I've talked about this a lot, but in certain communities, people don't feel like they're getting the best possible advice, or they feel neglected. And so that is not something that we want any client from any community feeling. We want to have this platform available to where you guys can get all your mortgage questions answered. And when you reach out to us as professionals, you can sit back and say, Aaron or Kevin, they served me in the right way. And that gives us an opportunity to serve other family members. And at the end, everybody's winning, because you guys are purchasing real estate. You're getting the benefits of the appreciation, the equity, but more importantly, you're creating memories in that house for you and your family, which really can't even be quantified. And for us to even have the opportunity to do it and serve you guys is an honor. So again, I appreciate Kev. Like I said, D-Wade to LeBron. Throw it up, I'm going to throw it down. Boom!
So guys, my sentiments are the same. Like, I've seen people absorb some of the information that I have provided on my channel, and they've closed somewhere else. I've also seen people take information from my channel, reach out to me, get pre-approved, and then sold a pipe dream. And then they came back to me to ask me to help, or to say, hey, you were right. And I'm not saying that to be boastful of myself. I'm just saying, if I provide you with information and numbers, they're pretty accurate. I'm never going to use the banana in the tailpipe. I'm not going to give you lower interest rates. I'm not going to give you lower fees to keep you as a borrower and then increase them.
Right.
I'm always going, on the higher side in this market. I'm going to be honest with you and say, we're going to lock you at a little higher rate. We're going to quote you at a little higher rate in case rates increase while we're in this market. We've already, planned for that. I'm going to probably inflate your closing cost numbers just a little bit, because we may run into a situation where the property is in the city limits and county. So then they pay city and county taxes because we don't have a property yet. Right. I would rather cushion for those things than for it to come up and bite us and then we can't recoup. I'd rather tell you you need 20 grand and you only need 15 than to tell you need 15 to get you in a deal and you really need 20.
Right.
So that's how I like to make sure I prepare buyers. If Aaron alluded to it, if you are looking to do FHA, but you're going to try to Airbnb the property and not live in it, I'm not your guy. I'm not your guy. I enjoy my freedom, and I enjoy the ability to make money for my family with my loans.
Right.
That's considered mortgage fraud. Now, if you want somebody that's going to, and I think I can speak sentiments for both of us, if you want somebody that's going to guide you through and have a lasting relationship, then I think you should come to us. Because right now, I feel like I have the ability. Right now, I feel good because I have clients who purchased their home from me. They have equity in their property, and now they want to get into investing. So then I can help them utilize that equity and put into investment property. So they're making money on that money that they've already put into it. So those are the type of relationships that I like to build. I'm around. I mean, I just refinanced the client that I sold the house to 12 years ago. So my guy Aaron over here is amazing. Again, guys, if you have any questions, we've got a few more minutes. I've got a few more minutes. If you have any questions, drop them in the chat. If you have any topics that you'd like for me to talk about or to do a video on, I'll definitely do it. Anybody you want to, as a speaker, I'm working on getting a closing attorney to come on so they can discuss title, closing cost fees. We had insurance last week. I'm also going to work with a realtor. I'll never forget, and I thought this was funny. You guys might not laugh, but I remember I was talking to a girl, and I said, "How much did you put down for earnest deposit?" And she asked me who was Ernest.
That's pretty good. I'm gonna use that one. That's pretty good.
She's like, "Who's Ernest?" I was like, "Escrow." She said, I'm doing USDA. I don't have to have any money. I said, "Yeah, you have to put some type of deposit down." My realtor never told me. It's just those small things. And no shade to the realtor, but she wasn't educated. She wasn't educated on that process as to her expenses, where she's got to do a deposit, she's got to pay for the home inspection, and she's got to pay for the appraisal up front.
Yeah. Gotta be educated, man. Gotta be educated. Gotta be talking to your clients. And Kevin knows that I take a lot of classes, earn certifications, just because I gotta be able to serve you guys a little bit better. Serve you better, always learning every single day. What can I do to help my clients? Because listen, we're only as good as the last deal, and every deal is different. And that's because every customer is different. So one VA loan is not the same. That's why I always talk, you know how it is, Kev. Talk to your clients, they're like, "Oh, my cousin got a VA loan, and she said, did your cousin say that she had a 700 credit score and she put down $50,000? Because that is not you. And those are not your circumstances. So that's why you got to talk to lenders to make sure that you're getting accurate information, specifically in this environment to where it's just dog eat dog. You want people that are going to be out there serving you and are genuinely looking out to not only serve you and your family. Kevin and I talk about this all the time. I have clients that I've served. I've probably done like 30 or 40 deals for in the last 10, 12 years that have they started with me, their children, their uncles, nephews, their entire families. But it's just because of how we serve our clients with excellence, and we're just thankful for the opportunity to do so.
Awesome. Again, guys, if you are new to the channel, do me a huge favor and subscribe. I typically try to go live once a week. Typically it's on Thursdays, but this week we chose Tuesday. If you're watching the replay, you might want to go back to the beginning or wherever you started and listen to it from the beginning. If you're just joining and you missed the beginning, I say go back to the beginning and watch this live. It was about, are you a qualified buyer? Are you a good loan? We talked about what a good loan looks like to Aaron, what a good loan looks like to me, what a good loan looks like to a bank or a credit union as well. My parting shots are, if your goal is to be a homeowner, at least get started in the process.
Right.
Just apply. You'll typically get a game plan. And if you're not ready now, I know I do, and I know Aaron does, we'll give you a game plan to set you on track. everybody isn't in position right now to purchase. But just think, 3 years ago, we were in the middle of COVID, but it don't seem like 3 years. So if you had started then and it took you 3 years in order to get ready, you'd be positioned now. Aaron, any parting remarks?
Would you lend you money? I mean, that, like, I know it's very, real simple. Would you lend you money? And if you said no, why not? And typically when as clients, when we start talking like that and we start to get into the weeds of the loan, they start to fix all the issues because it's like, you know what? I paid this late. I did this. I don't have enough savings. I did it. All are just basic loan characteristics. And if you guys focus on just the basic stuff, which is improving your credit scores, if you already have great credit, great, keep it that way. If you already have great savings, guess what? Great, keep it that way. If you already have no debt, guess what? Great, keep it that way. If you're the opposite to where your scores aren't where they need to be, start working on them. Start developing some savings. You guys will be very surprised. Saving either anywhere between like $3,000 to $5,000 on a loan can make or break an approval. We see it every single day. It can literally take you from not being approved to get approved. And then the main thing is like I talk about this, but continue to improve your skills. I talk to so many professionals out there. There's a lot of income opportunities out there, but we're in an environment to where you got to have economic skills, particularly in this housing environment. Whatever you guys can do to improve your skills, job promotions, starting businesses, things of that nature, those are things that are going to help you purchase property in the near future. But would you lend you money? If the answer is yes, keep on doing what you're doing. If the answer is no, we can get you on the plan to start working.
Stop doing what you're doing if you want.
Yeah, stop doing it. Right. Yeah, man.
Stop lending. Hey, guys, it's been great. Aaron, tell them how they can get in contact with you if they're in one of the states, or how they can follow you on Instagram or YouTube.
Cool. Well, you can follow me on Instagram at Aaron Approves Loans. You can follow me on Aaron Approves Loans on IG, Aaron Approves Loans on YouTube, Aaron Simmons AMP on Facebook. And like I said, you can reach out to me, AaronSimmonsTeam.com. But I look forward to working with you guys. But you see my big head, you just Google my name, you'll find me. I'm there. I'm on the internet. I'm in the street.
Hey, guys, thanks for tuning in. Have a great night.